Hello, everyone. My name is Nausheen Zainab, and I welcome you all to KiwiTech's 808 workshop for startups and entrepreneurs to help them navigate the challenge of starting a business, making it sustainable, and taking it to the next level. Today, we have the mentor session on early stage fundraising, Silicon Valley VCs due diligence process by Zamir Shukho, GP and founder, Vibranium Venture Capital. Before we begin with our session of the day, I would like to invite our VP VC and Corporate Partnerships, Jessica Chinfu, to give a quick overview of the company. Over to you, Jessica.
Thank you, Nausheen, and hi, everyone. Thanks for joining on our exciting entrepreneur workshop, bringing accessibility for all entrepreneurs. For those of you who are not familiar with KiwiTech, I'll give just a quick rundown of what and who we are. So we're really an ecosystem of innovators, founders, mentors, and corporations that come in to support early stage startups in their success. So we have about 500 plus portfolio companies. I've seen some in the chat joining today. About 3,000 investors in our network. We've helped raise over 100 million and also are providing technology services in exchange for equity and have done so for over 100 million. How did we get here? This is the second venture from our founding team. The first one, they exited at 144 million the last decade, and then started KiwiTech to tackle exactly bringing on resources for early stage startup and building a community around that. So we've launched various programs to add value, from accessing capital through our demo days, which now have picked up to be virtually, our 808 workshop series, which you're attending today. We've expanded as well in the Middle East region. Have reached that 500 portfolio company mark over 2 years ago and are on track to double that within the next 2 years. Those are some of the services we provide to really support when human capital is inaccessible at the early stage. So being that extended team to you. So from a technology perspective, financial and accounting, supporting, reaching, accessing capital through a crowdfunding platform and events. This is the ecosystem of events that we've fostered throughout the years, opening up dialogues for founders that are underrepresented to also different tiers of investors, whether it's from a family office, VC, as of today, we will hear, or angels. What are some of their insights or know-how to learn? And with that, I will kick it back off, and excited to have Zamir join us today.
We have recently introduced a referral program at KiwiTech. This program rewards anyone who contributes to fruitful introductions to our company over the years. We have built this robust ecosystem of startups with the help of your trust and subsequent referrals. We realize it is time we give due credit to this trust through our referral program incentives. So if you know someone looking for tech development support to scale, join our referral program and follow the mentioned steps shown on your screen, or visit our website. Contribute to our growth journey and earn incentives for your trust in us. I would now like to invite Zamir, GP and founder, Vibranium Venture Capital. The screen is all yours, Zamir.
Thank you so much. I'm going to ask to help me with turning my camera back on. Hello, everybody. My name is Zamir Shukho, and thank you, KiwiTech, for organizing this event. Today, I will be talking about raising your seed investment. And let me do a short intro. I'm a serial entrepreneur right now. I perform a role of a GP of Vibranium Venture Capital Fund. I'm also a CEO and partner of Global Venture Alliance. And we've been building acceleration programs for the last 8 years. Now we actively invest, and at the end of my presentation, I'll tell you a little more about our focus and what we like to see in the startups. But here are some more things that I've done. I would be happy if you reach out to me on LinkedIn. Let's connect. Let's stay in touch. Hopefully, whatever I tell you today can be helpful in your endeavors to raise your future seed round. Now, let's talk a little bit about the thinking that investors have, right? Because this is a special category of people who already made their money elsewhere, right? They already either had a business or, a family office. So they know how to deal with money, but now they would like to invest that money in different assets, one of which is potentially a startup or a group of startups to create a portfolio. So they have a certain way of thinking, and they have questions that always arise before they invest any amount of money into any type of asset. And usually they would like to earn money, right? Because they want to make sure that anywhere they invest gives some kind of a return. On top of things, they would like to diversify their portfolio. A lot of times, investors who are working in VC come from different spheres. They come from investment banking. Sometimes there's large investors in real estate. Some folks who are entering the VC market now are ex-corporate executives or at different corporations opening their CVCs. So they want to make sure that besides their other investments that they have in businesses, in real estate, in stock market, etc., they diversify and they touch upon some innovation. So investing in startups a lot of times is exciting because startups solve big problems for millions of people, and usually they're backed by very interesting, innovative technology. Investors want to find a strategic asset because whenever you invest in startups, this is we call it a midterm to long-term investment. Sometimes it's 5, 7, and maybe 10 years before you can exit out of a startup company, especially if you enter on a pre-seed or seed stage. So for that matter, we call it a strategic investment because for many years, that investment will be just there. There's not much liquidity, so you don't have too many options to sell your little portion inside of a startup. So you have to wait until the startup is going to be acquired by a large player or strategic investor, or until that startup gets to an IPO. Sometimes investors want to self-actualize through an investment. Let's say I enjoy music, but throughout my career, I didn't have time or I didn't have enough energy to do music myself. But because I'm a fan of music, I want to invest in a startup that helps musicians, organize concerts, work with fan base, etc., etc. So this way, even though I did not achieve it myself as an investor, I can self-actualize through an investment into a startup, still being close to things that I like, to things that I enjoy and I love. And of course, finally, again, being an investor, I would like to earn money investing in a startup. So this has to be something that will grow, will create value, and that will return the initial investment. Now, there are a few questions that investors usually ask themselves. There's a lot more of them, of course, but I outlined several of them for you guys in order to make it a little more clear. Let me try to move this little bar away. Okay, so is this a growing market and technology? Again, if you look at certain things, there are more stable markets like e-commerce market, very understandable business model. It's been around for 15, 20 years. People still invest in that. One of the largest companies, out there, Amazon, is a giant in e-commerce. So those, markets are still growing. There's technology behind it, but is it, still exciting and interesting for investors? A lot of times investors who seek innovation and technology, they'll be like, okay, if you're an e-commerce startup or you're creating some kind of a marketplace, we'll probably skip that because we've seen, hundreds of them already by now. But again, it has to be a growing market. Usually, I would say 10, 15% annual growth is good. Some of the markets are very exciting, like SaaS market, supposed to grow, around 18% a year. So the market has to be big. And I'm going to give you a lot of numbers today, so I urge you to, write them down. Usually, when it comes to size of the market, we like to look at the market which is $5 billion and above. So whenever you work on something and the market is less than $5 billion in size, maybe you got to think about, what can make this market larger for you, what kind of a pivot in your business model or technology that's backing it up. And again, use of technology is also important because that has to still be growing, or otherwise, if technology is obsolete and it's kind of getting old, and everybody understands that this technology is going to be substituted by a next generation and there's something better coming up, it's not that good to base your startup on the technologies that is going to be obsolete. So keep that in mind. Try to look ahead of a time, try to always seek for better platforms, better technologies out there to use to build your product. Now, of course, it's important how fast this company will grow, right? Growth is important. There is a basic formula. It's called T2D3. So whenever we look at startups, first 2 years, the growth has to triple, right? Triple 2 years, double the next 3 years. So whenever you are building a company, you want to make sure that you hit those growth levels in order to be a venture startup, right? So to be backed up of venture investors. That's what we like to see. T2D3, right? Triple first 2 years, double next 3 years. Would this be a good portfolio company to be proud of? This is another thing that a lot of times is skipped by startups. But there's some ethical questions in some of the businesses that people do. For example, a while back, marijuana was illegal. A few years ago, it became legal, and there was a lot of startups that started, creating technologies, growing and selling marijuana, et cetera, in California, right? In the state of California. Now, some investors still did not go into those deals, even though those companies showed great performance and fast growth, because of the ethical questions, because they believed that I'm probably not going to be proud of a company that is selling, marijuana, even though it's legal, but I don't want this to be part of my portfolio. So you got to consider these questions, especially when you work with investors from different cultural backgrounds. Middle East, there's a whole group of investors there with a lot of money, very fast growing VC market, a lot of seed funds and business angels, but they will not fund, for example, a startup like OnlyFans, right? That uses some sort of a nudity in their business model. So you got to keep in mind these questions whenever you try to approach an investor. Say, okay, is my startup something that this investor would be interested in having in his or her portfolio? Now, how trainable and receptive is the team, right? Well, the team is one of the crucial things inside of a startup, and I'll talk about this more. And whenever you have a dialogue with an investor, it's always good to listen. It's always good to stand your ground, but being receptive, being noticing the feedback, replying properly to that feedback, and maybe correcting something in your pitch or in your presentation, in your slides, or in any part of the business that you get a feedback on is always good, because whenever I invest in startups, it's a 5 to 7 years relationship. And of course, I want to add some value. Of course, I would like to be a mentor, and help founders to build a successful company. So being receptive and accepting feedback would be an important part of our relationship, right? So me saying something or giving an advice or referring a contact, and then startup acting upon that in a professional way. If that doesn't happen, I'm going to have doubts that this relationship will work out, because it is a relationship, right? It's almost like a marriage with an agreement to divorce in 5 to 7 years, right? So make sure that you try to understand where the investor is coming from when they give you feedback, and take that feedback as as something to use to make your startup better. Of course, investors think about how they will exit from this deal, right? And important thing is for the startup to have a vision of an exit strategy for the investor. If you come to an investor meeting and you don't have an exit strategy, even outlined in basic 1 to 3 steps, I'm not gonna propose you the exit strategy. I would like to hear it from the startup. So that's something you should definitely think about before the dialogue, before coming to the meeting, as where are you driving this company in 5 to 7 years, in 10 years? What is your eventual goal? What is your exit strategy? And the final question I would say that is important is, will this require a lot of my time? Meaning, do I trust the founding team to do everything on their own? Do I believe that they're capable of pulling this off and creating a successful business out of this? Or am I going to be, bi-weekly meeting with them and doing a lot of hand-holding and explaining things, trying to help them avoid a lot of these mistakes, etc. For that reason, investors really appreciate and like serial entrepreneurs that already did all their mistakes in the past. Of course, not everybody has that experience, and it's also okay. But as much experience as you can get before having your own startup is always good. Either working in a corporation or starting a smaller business, even a simple business like opening a Subway or something like that, which would give you an entrepreneurial experience, is always good to have that behind you when you when you launch an innovative startup and when you have a dialogue with an investor. So going to the next slide, I would like to show you this curve, right? The venture capital curve. Sometimes investors don't really like this. It's a J curve because everybody says, okay, when are you going to be break even? Okay, show me the revenues, show me the profits. Come on, let's do this. Let's do this next year. Okay. And it doesn't happen next year usually. So this just a simple explanation. Whenever you talk to the investors, don't keep their hopes up right away that everything is going to be amazing. I mean, it's always good to have the certainty, but expectations should be met. So don't create higher expectations than you believe that you can really pull off with your performance. Have like a plan A and plan B whenever you start showing the way you're going to grow, because every time we see this, right, we see the J curve, everybody is showing, oh, we're going to be going out of space, but that J curve usually does not go below 0 in your presentations, but in real life it does go, because the money that you attract as investment is basically a loan, right? A lot of times it's actually structured as a loan. So you are actually borrowing money, building your product, building your company, building your sales, building your team, etc. And then you go down below 0, and then when you start getting the revenues right there on the very bottom, then you start slowly pick up, and then you go skyrocket. So just keep this picture in mind and make sure when you talk to an investor that the expectations are met properly, and everybody understands how many years will it take to get to the break-even point, how many years, or when you plan to start growing, etc., etc. And I'll show you in the end a very important table with some numbers. And again, I urge you to, write some of those down, because that would be your benchmark whenever you try to raise your seed or you try to do a Series A. This is something that my team has done, pulling research of almost 500 SaaS deals, and I'll show you some of those numbers. This slide I created just to show you the two important things that it's like a debate. What is more important, right? Is it a strong team, or it's a cool product, really amazing innovation, something disruptive in a big market, et cetera, et cetera. And whenever it comes to early stage deals, let me give you an answer. The more important thing, and I'll then show you some research that proves that, the more important thing is the team. Okay, it's always the team in the beginning, because you don't have much metrics to show. You don't have much traction to be proud of, but you are basically showing yourself, saying, hey, I know what I'm doing. I'm capable of doing this. I have amazing people standing next to me, working with me as a founder, my co-founders, my core team, etc. And we're building something really big. And we definitely will hit some, some walls. There'll be some pivots, there'll be some problems on the way, but we know how to handle them because of our previous experience. So the dialogue a lot of times is about the team as number one priority and number one belief that this is really going to happen. And let me show you some information from a friend of mine. He's a Stanford professor, Ilyas Tribulayev. He has a team of PhD students, and they do a lot of really nice infographics. Now, important factors for VCs in selecting deals. Look at number one. 95% say the team is the most important factor. Okay, and then you go business model, product, market, valuation. Does it fit my portfolio, etc. Go down, all the way down. And if you look at it, the fit and is all the way down there, and even the industry. So it doesn't really matter whether it's an industry I really understand or I understand less, as long as I believe that the team can really execute. I give you an example. Right now, we just closed the deal with one startup which does an amazing thing. Like they create these 5G networks for local, for any corporation, any company. They can just do it really fast. This is a heavy-duty telecom hardware plus software, and I'm not a deep expert in telecom. I've been working with telecom companies in the past. I can understand how this technology works, but if you start asking me, explain me exactly how it works, going into very deep technical details, I probably won't be able to do it. Did that stop me from investing? No, it did not, because the team that we invested in has 15 years of experience working together. All 4 co-founders worked together for 15 years in another company that they've sold. So these are serial entrepreneurs, very experienced in what they are doing. And whenever we asked them any question, we created, we had a technical due diligence process with external experts asking them questions. They answered all the questions, and the answer was very clear, and it was, professionally processed. So just to give you another reassurance that team is extremely important. Now, we all understand that in the very beginning of your life cycle with your startup, it's hard to hire very experienced people. Usually it's, friends or somebody you start with. So you can get a little bit more support by adding advisors to your startup. Okay, having several top guys from the industry, well-known, some corporates or ex-startups, entrepreneurs, etc., in your advisory board would really help you out to reassure that whatever you're doing is good, that there are people who put their name on this, agreeing to become your advisor. And at the same time, you have somebody to ask questions to, because where you're CEO of the company, you're basically on top of the pyramid. Everybody comes to you with their questions, but where do you go with your questions when you have doubts? That's why you have the advisory board. And I also look at existence of an advisory board when I interview a startup for our due diligence process. I was asking, who are your advisors? Where do you go when you as a founder you have questions or problems or obstacles in the way? So you can make your team stronger with this external advisory board, thus reassure the investor that you know what you're doing and you have experts right next to you to help you out. Really quickly about the ABC team members, try to hire people, A-class people, those who will drive company together with you, that you don't need to micromanage, that you don't need to always tell them what to do, that you sit down, you synchronize, and you go to your areas of responsibilities, and everybody keeps working, so everybody's motivated to do that. Another slide about methodology. This is a 6T methodology that was created in Stanford University. Some of my friends who teach there, they use this to evaluate deals, and they show this to their students, and they show this to startups and investors. So this is a methodology that was based on several thousand deals that happened, and the team inside of Stanford, they did the research. Again, just like Ilyas Sribulayev's team, this team has conducted the research, putting priorities in the question of verifying if the deal is good or bad. And again, number one criteria was the team. So they are not just placed here randomly; they're placed in the order of importance. So the team was the most important part. So I can't stress this enough. Please, whenever you create your slide decks, whenever you create your pitch presentations, you must have the team slide, but emphasize more on your experience, on why should investors believe that you can make this a success. And the rest of it is TAM, is the market size. I mentioned this before. Technology should be disruptive, should be interesting business model, something new, something that changes the status quo, the way it's done right now. If it's a conservative area, like, I don't know, hotels, restaurants, or something else that is still behind, or construction, that you are creating something that is going to be disruptive to what's going on. The traction, yeah, we mentioned that, but not a lot of times you have enough traction to show at that point. But any good numbers, anything that you can measure is always good to show to the investor, because whenever you measure something, you can make it better. So try to start measuring different things, but avoid vanity metrics, right? Avoid just saying, okay, I have 1 million visitors on my website monthly. Okay, how many sales from that 1 million do you get? Like, how much conversion, into a final stage? So vanity metrics don't really matter. Try to focus on different numbers that make sense. And trends is something I did mention, meaning that, are you doing something that is growing, right? Are you riding on this wave of a trend? Are you aligned with what's going on in the business? For instance, if you came to me during COVID and you said, I want to open up an offline dancing school for children, I'll be like, well, my friend, that's probably a bad idea, because the trend is offline businesses are dying because of COVID restrictions. And why do you want to do that? Just a simple example, to make sure that you're watching what's going on globally, you understand what you're doing here locally, and that you are aligned with those trends. Terms is the final thing, if the deal is interesting to me, if it fits the investment focus, et cetera, if your valuations are good, and we'll talk about that in a second. This picture is out there. I'm not going to spend too much time. Just, you can find it, if you Google it. It's just a very simple one-page explanation about the funding cycle, about, the idea stage, the family and friends stage, the seed round, the Series A, etc. So just for you to have a visual on how it's usually built. What's the dilutions? Why do you lose portion of your company when you attract investment, et cetera, et cetera? What is an option pool? I'm sure most of you guys already know this, but just another visual about how it's usually done. Very simply drafted here. We don't have too much time today, so that's why I'm going a little bit faster through my slides. But the 20-30 rule, again, some of you already heard this. Guy Kawasaki, Apple evangelist, he created this rule. It's very simple. Whenever you want to pitch and you want to get somebody's attention, try not to make it too heavy, like 10 slides plus or minus, a couple more. Try to keep it under 20 minutes in your presentation, and use big font. Don't put too much text. So just bullet points of what you want to say, because you want to make sure that investor is not looking at your slides. Investor's supposed to look at you, and you're supposed to present your company. The slides are just supporting whatever you're saying. So less text, please. Very precise on what you want to say, not more than 2 minutes per slide, 10 slides. Just keep that in mind. But again, pitch is only the first step, right? So it's just to get you into the door of the fund, get an interest, during a demo day, during some pitch presentation event, etc. And I would say it's only step 1 or maybe 10% of what you need to do in order to close the deal with an investor. I'm gonna quickly go over certain things that we do in our due diligence process, so you have the whole picture of what is out there, what is awaiting you when you deal with a professional venture fund and you try to raise your seed investment. So this is an 8-step process that we have. When you did your pitch during your demo day, my scout would come to you and say, hey, you guys are interesting to us. Please fill out our form on the website. And that gets you into the pre-screening process. And the pre-screening will look if you fit the criteria. And I will show you later on the criteria that our fund has. And you look at the criteria and you say, okay, do I fit all 10 or all 9? Do I fit only 7? Should I still apply? You applied, but the team will look at it and say, okay, they match 5 out of 10, so probably we'll have to pass. If they match enough, you will go to the next stage. The primary screening, so I have an analyst look at everything you provided, your pitch deck, your financial model, some of the numbers that you gave, etc. And then he looks at it, and we use a 6T methodology. I mentioned that methodology to give you scoring, up to 100 points. Then if you pass, you go to the next stage and you get an interview with one of the investment managers of the fund. Talk about your business model, your technology, your go-to-market strategy. Then you get an evaluation after that interview. If you pass with certain points, you go to stage number 4. Step number 4, you get an interview with a GP. Most likely it will be me or my partner. And I talk to you about your team. I talk to you about the current market situation. I talk to you about the trends that are happening. I talk to you about your sales pipeline, your strategy, etc. And then we look at your current deal structure, who also is in contact with you from other funds, angels who give you soft commitment, etc., etc. So we talk about all these things. Once you pass that, we start a complete due diligence process. Now, due diligence, we do in 3 verticals. Financial due diligence, we look at all of your financials. I have slides about that. Legal and technical. And sometimes we do KYC. After that, there is an investment committee, right? So the final decision-making process, we look at you, you present, we ask you some additional questions if there are any, and we vote. Once we voted, it's all good. If the decision is yes, we start the deal structure, and we've already talked to you about the deal structure, right? So we already have the term sheet in place, etc. So it's just finalizing it, signing everything, and then we transfer the money. And eventually you end up in our portfolio, and that's a whole new process of living together as our portfolio company. Today, I'm not going to talk about it. It's very interesting. We can do it some other time. Now, really quickly, what do you get in a financial due diligence? What we look at. And again, I want to show you these things, guys, because the pitch is only the beginning. You have to have all of these things in place in order for investor to really give you money to close a deal with you. So we analyze your management accounting data. We look at your taxes. We look at a financial forecast, your financial models. We look at your debts, your different loans that you have, different liabilities, and we look at we analyze the level of business risks. Like we look at some of your competition, your market positions, etc. Technical due diligence. We have a special team that looks at your architecture, infrastructure. How is your development process organized? We look at security issues of the application, your copyrights, any use of any third-party applications, licenses, restrictions, etc. We do a code review. We look at everything that you've coded. Sometimes it's a portion of the code. And then we test the product. So we try to use it as just a general person, going, clicking, hitting the numbers, hitting the buttons, trying to break the product if it's possible, just from the user standpoint, doing something dumb to see, how bulletproof is your product. On the legal due diligence side, we look at, ownership shares. We look at the compliance with the legislation. We look at your previous relationship with your other investors. We look at intellectual property. This is one of the most important things that is being neglected a lot, is the protection of intellectual property, your trade secrets, your trademarks, etc. Especially for those startups who are coming from abroad, from different geographies into the United States, they forget that they need to do all of that here, even if they have protection in another country that does not cover the United States. We look at your labor relations with your employees, the contracts signed, etc. Maybe lawsuits, licenses, patents that you filed. We look at all that. We verify if any of your founders, shareholders, or current investors are in any sanction lists. Unfortunately, those exist, and that can be an obstacle in a way, a deal breaker. And sometimes we do a KYC, so we want to know more about the co-founders, etc., and we request some additional information. And there is such a thing as CFIUS. It's one of the regulators that we also look into. If your technology is sensitive technology, space tech, cybersecurity, AI, you name it, there's a bunch of things that CFIUS is very interested in. So if we have to, we have experts from ex-CFIUS employees that also look at the project and make sure everything is good and intact. Now, this is the table that I want to share with you. You will not see this anywhere. So take a picture of it, but please do not post. This is just for your internal use. This is really a benchmark of what we look at when we want to invest in a startup. All of these parameters, all of these metrics matter. They are connected to each other. And whenever somebody does not fit these metrics, it means it's probably a bad deal. So let me give you information about the seed stage, because the rest is a little further on. Usually when somebody comes to us for an investment, if that company is raising seed round, that company should not be older than 3 years. If you're older than 3 years and you're just raising a seed round, maybe you've been developing too slow. We look at your past revenues, right? So by the time you come to us for your seed investment, you would have close to maybe $500,000 in revenues. That's the median, you see that? And you should have been growing for the last year close to 300%. That's the minimum, I would say. So 3x, remember I mentioned this. First couple of years, 3x, then double the next 3 years. Your valuation will be somewhere in between $6 million to $17 million. So the median is $10 million. So if that's your valuation, you are a seed stage startup. That's pretty close to where you can get your valuations at this point of the market. Revenue multiples, the median is 18x. So whatever your revenue is times 18, that's your valuation, and you can negotiate that with your future investors. The common size of the round is around 1.5 million. I see larger rounds in the United States, of course. They are 2 million, 2.5 million. Sometimes we see a 4 million seed round. But the reason why you don't want your round to be too large, if your valuation is 10, 12, maybe $15 million, and your round is way too big, then you're going to give up way more than 14%, right? This is the next line that we have. Keep this in mind, guys. Every time you raise, the common amount of equity dilution is between 10 to 20%. It's acceptable out there in the market. If you raise pre-seed, you give up between 10 to 20%. If you raise seed, between 10 to 20%. If you raise A, etc., etc. Now, if you are trying to raise too much too early, the dilution is going to be much higher. Now, if you look at the next line, founder's equity before the round. If you come to me on a seed round and the equity that you owe is less than 75%, then it's a bad deal. That means you've raised too much too early, and you've struggled to have traction, sales, revenues, whatever. For some startups, it works like that. In pharma and biotech, med tech, whenever it's a longer R&D process. But when we talk about IT, SaaS, software, etc., usually you should be, much faster into showing your first revenues than those other startups. So if you have been raising a lot of these notes, safes, convertibles, etc., smaller checks, larger checks for a long time, and you've diluted yourself to have less than 75% of your company left by the time you come to your seed investors, probably would be considered as a bad deal. And the reason for that is because you're going to be diluted in this round, and in the next round, and in the next round. And whenever you come to Series A, having less than half of your company, already losing control of your company, that's considered a bad deal by every other investor out there down the line, right? Up the food chain. So your Series A investors will be like, oh, you guys are way too diluted, you basically sold too much of your company too early. Now, the next line, which is investment total before the round, it means how much money have you raised before coming to a seed investor. The common number is close to $500,000. This does not include your own money. We're talking about not bootstrapping, not putting your own money in. So the more money you're putting yourself, the better it is, because you're going to raise less pre-seed money and you're going to dilute yourself less. So the more you bootstrap in the beginning, the better you are when you have a dialogue with investors, where you have higher portion of your company. Sometimes I see founders, they come in with 100% of their company raising their first seed round. This is really good because they've been bootstrapping, but don't bootstrap for too long. If you've been bootstrapping for 5 years, then you're not a venture startup anymore. You're too slow. You've been bootstrapping for a couple of years. Now you're raising your seed round with almost 100% of your company. Good. We'll look at you. All right. And then the important piece here, I have about a minute left in my timer, but important piece here is, what are your goals for the next round? Again, your strategy, right? Investment strategy. I mentioned this before. If you come to me, I want to make sure that you know what is your next step in 12 to 18 months, right? So these numbers here in the same column, the future revenue. So if you're raising seed round 1.5 million, 2 millions, we want to make sure that this money is enough for you to get to $3.5-4 million revenue, where you will be eligible to raise your Series A. We want to make sure that your revenue growth rate, you see, 580%, so 5x. This is big, but this is a median number that we've seen in top quartile of deals out there when it comes to SaaS startups. Your expected valuation on the next round should be 5x your valuation on your seed round, right? Again, this is expectations. This is what we're talking about, good deals. We want to make sure that when we invest, startup has this potential. Of course, 4x and 3x is also okay. Nobody says it's bad. I apologize. My timer went off. But we want to see this potential in your model, and that model that you put, a financial model saying, I'm going to make 3.5 million in revenue next year, that has to be supported by your marketing plan. That has to be supported by your sales pipeline, has to be supported by the sales force that you have, or you will hire with the money that you get right now. So all of that has to be aligned for us to believe that, okay, these guys will definitely make it. They will definitely pull this through. Now, capital consumption. This is something that startups don't really think about, but investors do. Capital consumption means I give you $1 million investment. I expect that you will make $2.5 million in additional revenue. So $1 to $2.5 ratio is a median, makes it 0.4, right? Here, I'm showing this in the table. Of course, you can do $1 investment converting into $2 of revenue is also good. $1 converted into $1 of revenue is the minimum that we would go for. If you're taking $2 million investment to show $500,000 revenue next year, it's a bad deal. This ratio is bad. And then we will say, okay, we're not going into this deal. And the burn rate, this is final. Okay, you have to make sure that the money you attract will be enough for 12 to 18 months for you of burn rate. So usually seed stage startups have $80,000, close to $100,000 burn rate. So you got to keep your spendings, within that burn rate frame. Now, let me go and do a couple more things before I open up the floor to the questions. What about us? What about Vibranium? What do we do? So we are in Silicon Valley because this is the biggest ecosystem. 50% of unicorns are born in Silicon Valley, in the United States unicorns. And this is the largest place if you're concerned about the amount of deals and the money, the deal value, right? So we're still number one in the United States. Why do we invest in SaaS? Because this market is going to be growing at least 18% every year for the next many years. And we believe that this is a really good opportunity. On a growing market, of course, there's going to be more growing startups. The key investment parameters. So we like to see B2B SaaS. Sometimes we look at PaaS or other cloud services, industry agnostic for us. We invest in the seed stage, sometimes pre-series A, US-based companies, strong team, serial entrepreneurs. We like to see $40,000 in monthly recurring revenue in the US market when you come to us. So you already have that revenue when you come for an investment. We will look at your annual revenue growth, remember, 300% and higher from past year. The valuation cap should be no more than 25 million. This is the top of the seed round valuations. So we took it the highest out there. And we usually invest with a $500,000 check. Okay. That's just a little bit of a motivation for you guys. Whenever you go out there to start fundraising, you have to understand that in order to hear 1 times yes, you will probably hear 49 times no. So don't feel disappointed. Don't feel like you're doing something wrong. There's so many stories out there how these, super founders, super startups received 100 times no from stupid investors that missed this opportunity, and eventually they created a unicorn or even a Centaurs, that is worth billions of dollars now. So just don't stop. Just keep doing what you believe in, and keep on talking to more and more investors. Increase your pipeline dramatically in order to hit the success, right? In order to get to that investor who's going to be right for you and who's going to believe in what you're doing and help you with their investment and resources. So our slogan is stronger with Vibranium. Vibranium, as you might know, is the strongest metal in the universe from Marvel. So whenever we invest in a company, we put a little bit of Vibranium into you to make you stronger. Happy to answer some of the questions. Thank you so much. And I'm stopping my presentation.
Thank you, Zamir. That was a great presentation. So we do have some questions. Where do you find advisors?
So a lot of times when you go to accelerators or you hang out in different events, etc., there's so many people coming to these events who've been around. Accelerators do give you advisors. I see many times alumni coming out from, I don't know, YC, Alchemist, 500 Startups, Plug and Play, etc. They already are surrounded by mentors and advisors. But if you are in no accelerator, I would urge you to find people that you believe are experts in your field. Look at the event schedule, see if they are talking at some of the events or if they're presenting somewhere or doing a lecture in a university. Go out there or reach out to them through LinkedIn or go out there and talk to them in physically and say, hey, I really like what you do. We really would like to show you the technology that we're working on. We believe that you are one of the top experts in this field. Please hear us out. And if that person likes whatever you tell them, then you come up with a proposal. Would you be our advisor, 1 hour a month, 2 hours a month of your time? We would really appreciate if you would agree. So something very simple. A lot of times people agree. I did that for many startups, just because we like to give back to the community. It's something that experts do a lot, so just be proactive about it, just approach them and ask them.
All right. Could you please explain the revenue multiple metric?
The revenue multiple metric. Okay, so this is an old metric that is just out there. It helps calculate. So there are different benchmarks. Like there's PitchBook, there's different resources where they show what is the common benchmarking at what revenue and at what valuation this particular startup closed the deal. So whenever you look at this research, you can figure out the median, right? So bunch of startups at $100 million valuation with $10 million revenue closed their investment rounds. That means a 10x ratio, right? So the common ratio for this stage, for this type of startup, etc., is 10x to your valuation, to your revenues, which is your valuation. So it's a common knowledge out there that investors look at from different platforms that we use. Like we use PitchBook, and we use other data like CB Insights, Bessemer reports, and all of these things we read to make sure that we are very aligned with the common benchmarking at this point with multiples that exist out there in certain verticals and certain markets. So this is our job, right? We have to keep our hand on the pulse. And that's the reason why I give this information to you. So you guys also, when you fundraise, you should definitely go and benchmark and see, hey, did I see any other startups in my field who raised, a seed round? At what valuation? What did they do? So you kind of compare yourself to them, and then you see those multiples. You see how much they raised, at what valuation, and what kind of revenues they had at that time. That's how you figure it out.
So I'm saying there is one more question. Are there different considerations for the seed round for a company that is older than 4 years due to COVID?
Yeah, so 3 years is not a set in stone like deal breaker, to be honest with you. Of course, there are different situations and reasoning behind why a startup did not raise at that point and why it was growing a little slower. I'm just giving you a heads up saying, okay, if you are older than 3 years, you probably should prepare a good answer why you are older than 3 years and you're just raising your seed round. So have a very solid answer. Be ready to say, hey, I know that I should have been a little younger, but we're still good. We're still strong, but we had some, slowdowns because nobody's perfect. None of the startups that we see hit all the criteria that I mentioned. Nobody, just zero. Okay, so it's okay to be not perfect. Nobody is, but the more numbers you hit, the better it is. And when you're lacking behind on some of the other numbers, you should have a good reason and a good explanation. Why is it like this now? And what are you going to do to correct it in the future?
All right. What differentiates a pre-seed from seed round? Similarly, what is pre-series A versus series A?
So when you talk about pre-seed, most commonly pre-seed is a smaller amount, like up to 500K. the startup is usually pre-revenue or has small revenue, $5,000, maybe $10,000 a month. And this round is raised from a lot of times unprofessional investors, private investors, or business angels. So people who don't really go deep into due diligence process, they just like you, they trust you, they give you the $100,000. They're like, ah, cool, I like your idea. So a lot of times these rounds are just to support your product development and your product market fit strategy, to make sure that you can show better traction and to get to faster to get to round seed round. Now, when you talk about pre-series A, this is sometimes it's called a bridge round, or some, startups, they calculated something, right? They said, okay, $2 million will be enough. And then COVID hit. And like, oh my God, we did not have this in our predictions when we were raising our seed. So now we're hitting some difficulties. We need additional bridge round, a pre-series A round, to get us to the milestones and metrics for Series A. Because those investors, they already told me, you need to have $3 million in revenue to come to me for investment. So I'm only at $2 million right now. So I need more investment to get to that. So, you open up a bridge or pre-series A for another $1 million, $1.5 million, $2 million to get you to that next point. Because, it's about the speed that you go with. You can probably do it with your own revenues, reinvesting your profits back into the company, but that's going to slow you down. So keep the numbers in head. Bootstrapping startups are also okay, but bootstrapping is almost 2 times slower than venture-backed, the development, the speed of development. So your curve is not going to be like a J like this. It's going to be like this. Okay, so you want to attract more investment to move faster. That's the answer here.
All right. Do you see delusions in revenue with vested companies? And if so, what is the VC doing to assist it if the vested company for ROI? Yes, it says, do you see delusions in revenue with vested companies? And if so, what is the VC doing to assist if the vested company for ROI? The question is in the chat feature.
Yeah, I see the question. You might want to clarify a little bit more, because delusions in revenue. Okay, let's talk a little bit about plan and reality. So startups show revenues in their plan, in their financial model, and a lot of times they don't hit those numbers. Those are predictions. We all understand that. So they get some slowdowns because customers don't close the deals fast enough, the technology still needs upgrades, etc., etc. So of course you got to have plan B. And whenever we talk to startups and say, okay, when you show us this financial model, this projection of your revenues, please show the very positive, some median, and the negative scenarios. So, and the plan, what you're going to do in those scenarios, what kind of spendings you're going to cut, how you're going to avoid this, how you're going to do that. So you should have those 3 scenarios whenever you try to predict, at least for next 12 months, your revenues, because it's not going to go according to plan. I'm just be sure it's not. Sometimes you can overdo the plan, which is great, but most of the times it's just not going to happen. And of course, whenever we talk to our startups, to our portfolio companies, we look at these numbers over and over again. Every quarter, our portfolio companies report and they say, okay, we've hit the numbers or we didn't hit the numbers. This is the revenues, this is a prediction, this is a pipeline. And what do we do to try to help, right? We try to introduce them to some new customers. We introduce them to other investors. We work with their, sales pitch or sales process. We try to tweak it a little bit. So there's a lot of this hands-on work from investors to startups to help them, right, with all these different things. But of course, startup is the driver of the process. I mean, I can only help a little bit, with an advice or with a contact, but the responsibility is on the founding team, to make this happen. Well, I guess that was
That is the correct reply.
Got
So
it. Great.
there is one more question. In your pitch, financial slide revenue year 2 and 3 show should be three times, 3x. That I think that's 3 times.
This is we're talking about the table. I'm looking at the
In your
table.
pitch financial slide, revenue
Mhm.
year, second and third should be 3x.
I would say to the minimum, right? So we all want to see a fast growing company. So this is like a minimum benchmark, and say, okay, if it grows 3x, then it's a good company. If it grows 5x, then it's an excellent company. If it grows 10x, it's a super champion. Again, keep this in mind, guys. When we invest in a seed round, we reserve another 1.5 million for the next round. And we will invest in the champion. So it's almost guaranteed that if you perform well, if you perform under those numbers and you show 5x coming to your Series A, you guarantee get money from us, 1.5 million. So we triple down on our investment because you are a champion. If we want to make sure that we still keep our stake in your company, or maybe increase that if it's possible, if you're interested in doing that together with us. So any investor that gave you money on the seed stage or in a pre-seed stage, if you show that kind of growth, almost guaranteed they will want to continue investing in you if they have the capability, if it's a fund rather than just a business angel or a friend. And again, when we talk to our friends, Series A investors, Series B investors, we say, hey, this is amazing, guys. We are investing again. Would you like to come in with us? So we go and we talk with other investors for you, making sure we get you the resources that you need, because we have, skin in the game. We want other people to put their resources in this as well, so everybody is happy and everybody grows. So again, whenever you perform well, there's going to be a lot of supply of investment money to you from your current investors and from your future investors. Vice versa, if you perform bad, I most likely say, okay, the first check was enough. So let other investors risk here now and see what happens. So we're going to just hold on. And again, we will do everything in our power to help the growth of the company, hiring the proper people, etc., giving you advice, etc. But it depends on the team solely. If you perform well, you get more money, you go on. If you don't, you get off the track.
All right. This is the last question. Can you elaborate more on the 500K check Vibranium writes? For example, is it a standard safe or discount or capped? What kind of terms do you have in your safe? Does Vibranium invest in social impact startups? Reason for this is because they don't have the same performance like a SaaS startup, and therefore might not meet some of your requirements.
Understandable question. It's a long discussion, but I'll give you a few things to keep in mind. We prefer to do a convertible loan agreement, CLA. We have a pretty standard according to the market standards, and we require certain rights, not the major rights, of course, because usually we come in as a second largest investor in a round. So we would like information rights. We would like pro rata, allowing us to invest in the next round. We would like a first refusal right, which would allow us not to invest if we don't want to, but we would have startup ask us first before they raise from anybody else. So common things like that. We don't take board seat. We usually don't take even an observer seat because we don't want to overwhelm startup with our love. We want to be this nice investor on the side that startup comes to and talks to when they need help, but we don't want to operationally get involved in your startup. So that's why we don't take a board seat. When it comes to impact startups, I personally like impact. I think it's important. And whenever we invest, we try to seek the impact portion in the vision or the mission statement of the company. So they should be solving some important problem right out there that helps. But our focus, though, is B2B SaaS. So because this is what we understand really well. And I, of course, know the metrics and the way impact startups work. And A lot of times there's a conflict between the impact and the financial part, right? And startups are being forced, even the ones that wanted to do impact, they're being forced by financial investors to start doing business. My suggestion here would be look for investors that fit you. There's a lot of folks out there who focuses on impact and saying impact is number one, financials and business number two. So I even have some friends, you know, who do that. It's a question of a fit. Remember, I had this, is this a fit, right? You know, between an investor and a startup. So whenever you're an impact startup, there are funds that do support you guys, and they do have the proper metrics for that to fit. We are more of a B2B SaaS fund.
All right. Thank you, Zamir, for the presentation and the great responses. And with that, I would like to thank our mentor and guests for joining us today. And we'll be back soon with more workshops. Also, apart from workshops, we have more upcoming events. As you can see on your screen, you can check out KiwiTech website for the same. Do join us, and we would love to host you on those events as well. Thank you and have a great day ahead.